What is up, you guys? Today we're going to be talking about the stock market versus real estate. Which one I believe is better for your beginner investor, and ultimately which one I believe is the better investment. Some pros, some cons, how to invest the best way in both of them, and overall my exact strategy into what type of real estate do I buy, how do I buy it, etc. So guys, hit the like button, subscribe to this channel, hit the notification bell because all of these videos are important to be seen in a timely manner. And also go ahead and check out our public Discord. It's 100% free. Discord is down below. There's a lot of free courses there, a whole bunch of free resources, and I live stream once a week there every single Friday. If you guys don't know who I am, my name is Peter DiCarlo. I run a company called Capitalist Academy, and we're going to be doing over $330,000 worth of revenue this year. And this channel is just my way to give back to you guys, to help you if you're somebody who is trying to start a business, if you're somebody who is new to investing, or you just want to grow your net worth over the long term. So this is my way to give back and to essentially share my 7 years of entrepreneurship and 8 years in the stock market. So let's get started and let's talk about this. This is a video that a lot of people have been asking me about because when you first start investing, or potentially, for me, when I bought my first piece of real estate, unfortunately, I had a relative, my mother, pass away, and I was handed a decent amount of money, 50 grand to start and decide what do I want to do. And for me, I was like, I don't know what I want to do. I was investing in the stock market prior to that. I really wanted to get into real estate, but I was like, I don't know anybody who does both of them really well and can give me a full breakdown on the pros and the cons and really get an understanding of what I want to do as an investor. So that's what this video is for. It's for you guys if you're somebody who's thinking in that manner, or if you just want to get an idea of what your roadmap of investing is going to be down your life. There are a lot of people I know who are very, very successful, who have made a ton of money in their career, and they just hate real estate. They just hate it. And I know a lot of guys who won't even touch the stock market and they put all their money in real estate. So let's get into it. So stock market pros. Let's talk about this first. This is really what I've built my business around. This is what I've built my life around. I do enjoy investing in real estate, but the stock market is really what I've built everything around. So this is going to be one of my favorite things to talk about. All right, the biggest pro in the stock market. There's no partners. You don't have to deal with crappy partners. My first investment that I've ever made in real estate, I had to deal with a crappy partner. It was terrible. I will never do it again. I don't even know if I will ever invest with partners ever again, just because of how bad it is when you have a bad partner. And in this instance, not having a partner and doing, starting to invest in real estate is so much better to do it alone. Now, you don't have to have a partner when you're investing in real estate, but at the end of the day, a lot of people who are starting out, if you might only have 5, 6, 7, 8 grand, you might have to raise money, whether that partner is going to be silent or not silent. And a lot of people say they're going to be silent until you take their money. The second pro is liquidity. So for those of you who don't know what liquidity is, it basically means how fast you can put money into something and how fast you can take money out of something. You can go ahead, put 10 grand into the stock market tomorrow, and then God forbid, if something terrible happens, you have to pay for a surgery, pay for a new car, pay for something, you can sell that position, and usually within 24 to 48 hours, you can take that money out of your broker account, and then you're going to have straight up cash to go ahead and do whatever you need to do with it. Something like the real estate, you can't do that, and we'll talk about that later. You could do like a home equity line of credit, but we'll get to that later on. The third thing is it's very easy to start and it's very easy to buy. All you have to do is just take your phone, download Robinhood, Webull, whatever it is, and you can open up a broker within about 20 minutes, and then you can go out and just start buying whatever stocks that you want. However, another pro is you need little to no knowledge to start and really little to no knowledge to make money. I didn't say make money consistently because that's much different, but in order for you to make money, it takes no skill and no knowledge. Like if I gave a chimpanzee, my phone, and then I was just like, hit whatever buttons you want, they theoretically could buy a stock and then just sell a stock an hour later and make money, not knowing what the company was, what the company did, what was the catalyst for the move, proper risk management, none of that. They could just hit a button and then make money. It's very easy to do it. It's very hard to do it, consistently. The next thing is there's no proof of income. So when you're purchasing a piece of real estate, you need to have first of all, you need to meet a lot of requirements, but one of the main things is you need proof of income to go and purchase that property. When you start in the stock market, you don't need any proof of income. Like, let's say you're homeless, you don't have a job, you have a phone that barely works, and you sell your bike for 200 bucks. You could take a bike and then you can put the $200 into your account. Maybe not homeless, it's a poor example, but you don't have any money, you're unemployed. You can take that $200 and put it into the stock market and start trading with it. Probably not going to trade well, but you can start trading with it. You can't just go buy a piece of property without having a job or proof of income. The next thing is dollar cost averaging monthly, or the ability to put money in each and every single week or each and every single month. One of the best ways to long-term invest that I teach a lot of people is dollar cost averaging, which means that you take 4 or 5 companies you really like, let's say like Apple, Amazon, Facebook, Tesla, and Netflix. What you could do is take $500 a month and every single month deploy that $500 evenly across those companies. However, if you have a piece of real estate or you want to start investing in real estate, you can't just take $500 here, $500 here, $500 there, and put it towards a property. You can't do that. It's not how it works unless you're buying a REIT. So that's another liquidity thing, the fact that you can keep averaging in every month. The next thing is that the market goes up 95% of the time. As long as you're investing in very strong companies, the stock market goes up 95% of the time. There are crashes, but that happens in real estate as well. The next is that you don't have to deal with people. You don't have to deal with agents. You don't have to deal with sellers. You don't have to deal with tenants. You don't have to deal with lawyers. You have to deal with any of that stuff. It's just you and a computer. The next thing is that it's very, very hard. I'm sorry, that is actually not supposed to be a pro. That is actually supposed to be a con. So we're going to remove that. Then I'm actually going to add that to the cons list because this is very important, and I actually have done videos on it in the past, and I'll explain that in more detail. Now, to wrap up the pros part, no wonder why 95% to 90% of people fail. And you might be like, wait, that makes no sense. You just listed off a ton of pros. Well, what's the one thing you notice with all of these pros? Anybody can do it. Anyone. There is no requirements. There is nothing. Anybody can basically just grab a phone and make a broker account. That's why 90% of people fail, because you don't have to be knowledgeable. You don't have to have a lot of money. You don't have to meet any prerequisites. You don't need to meet anything. And that's why 90% of people fail. That's why 90% of people fail their diets, because there is no prerequisite to get into it or to start it or to, begin a diet. And that's why so many people fail. Whereas with real estate, you at least have to build up, a big deposit. You have to have good credit, which we're going to talk about later on. So that's the pros. Now, what is the con? Inconsistent income is the first thing. A lot of people say, and like I said, I run a company, we're going to do $330,000 this year in income. And a lot of people say, and I had it during the live stream yesterday, why does everybody who is a consistent trader sell courses? Why do you think? Comment down below before I start. The reason we sell courses is for consistent income. As a trader, I have very inconsistent income. There are months where I'll make 5, maybe 6 grand. There are months where I'll lose $2,000 or $3,000. Ultimately, over the year, I will make money, and that's the point. But the goal is to have consistent income. And one of the downsides we're going to talk about too is that you cannot use your trading income as income to go and buy a house. So I put this here, and we'll jump right to it though, is this money that you make from trading will not act as income for a loan. Even if I made 200 grand this year trading stocks, if I go to the bank and the bank's like, okay, we're going to look at proof of income for you to go buy a house. And then they look at, oh, you made 200 grand, but it's from the stock market. They're not going to give me a loan because they know how risky the stock market is, and they're not going to give me money to go buy a house. So that's why I sell courses. That's why I teach people, because I like to help them, but it's also so I can make consistent income and then take that money to go buy properties. So went over those two. The next is very hard to make 50 grand in a day. A lot of you guys may be like, 50 grand in a day? How can you make 50 grand in a day with real estate? You could make 50 grand a day in the market if you had a lot of money, or you YOLO'd, which I don't recommend. But there are ways in real estate where you can make 50 grand in a day. My first property, we purchased it for $150,000, and then instantly the house was worth 200 grand because the house was initially worth $200,000, but we basically knocked the seller all the way down to 150 grand. And I have videos on that about motivated sellers, about how to find a deal like that. There's a video like how I made 50 grand in a day on this YouTube channel. I'll try to remember to link it. If not, I'm going to do an updated video now that this channel is bigger. But there are ways that you can find a motivated dealer. A motivated seller. So for instance, a really big one, unfortunately, is somebody dies. So sometimes you'll have a property that's worth 200 grand. You know, someone's parents die or grandparents die. The house gets left to somebody who lives on the other side of the country, and they don't want to deal with it. So instead of rehabbing it and then putting it up for a market or, at market value, somebody like myself comes in and I'm like, hey, listen, like I'll buy the house from you today for 160 grand, 170 grand. Instantly, that house is worth 200 grand, but I'm helping that person out by taking it off their hands very quickly. They don't have to pay a realtor. They don't have to do all these things to fix the house up. So it does help both parties. Of course, the person who's buying it for a massive discount ends up making more money off of it. And then what I can do is go do like a HELOC, like a home equity line of credit, and buy more and more properties. And it's kind of like a domino effect, but I'm going to do a video on it later in the future. So very hard to make 50 grand in a day. Another con is there's insane taxes and no write-offs. So one of the big reasons for investing in real estate is the tax write-offs, and we're going to go over that later. This is going to be a lengthy video, guys, so we're halfway through. It's about 10 minutes, so I just want to applaud you for hanging in here and continuing to do this. You are definitely somebody who's taking investing seriously, and you should pat yourself on the back for it. But when you're investing in the stock market, if you are trading like I do, you're going to pay about 40% taxes because you're going to get taxed short-term capital gains tax. If that means if you hold a stock for less than 365 days, instantly the government's going to take 40% of that. If you're investing long-term, whenever you sell, you're going to get long-term capital gains, which is about 15 to 18%. So the taxes are high. You pay a lot in taxes, and there's no write-offs, which is a big downside. Even if you took a $10,000 loss this year, as a sole person, not a company, but just as a normal person, you can only write off $3,000 a year. So you couldn't even write off the whole $10,000 loss. You could write $3,000 off this year, $3,000 off the next year, $3,000 off the next year, and then $1,000 off the final year. The next con is that it will not count as income, like I said. The next con is you cannot borrow money to trade, like a mortgage. One of the pros we're going to talk about with real estate is that you can actually borrow 95% of the money to go buy a property. You can't borrow 95% of the money to go invest in the stock market. And what you could do is margin, which I hate. I don't recommend it. I do recommend you have a margin account. Just don't use the margin. But even if you take margin out, the margin rates are nuts, like 15, 16, 10% a year, which is crazy. The other thing too is that if you go to Wells Fargo, I think Grant Cardone said this, one of those people, but if you go to Wells Fargo and you're like, hey, I want $400,000, I want to borrow it to go buy Wells Fargo stock, they're going to laugh in your face. If you go to Wells Fargo and you say, hey, I want to borrow $400,000 to go buy this property, they're going to be like, okay, cool. Here's your interest rate. Here's how much you have to put down. Let's go and do it. So not even banks believe in the stock market enough for you to go and loan you money. And the next thing is there's actually a 10% chance of you trading consistently and doing all of this correct, which we spoke about before. It is not easy. Now let's get into the real estate aspect of things, and let's talk about the pros. Pro number one, massive, massive lending. Like I said, 97% at times. If you guys want me to, I can do a video in the future talking about the difference between residential loans and commercial loans and which ones I like to do and why I don't really buy more than 4 units per building. But comment down below if you want me to do a video like that. But you can get up to 97% funded by the bank. So for instance, the house that I'm living in currently right now, this house, I've owned properties before, but this house is owned under my girlfriend, and she only had to put 3% down on a $300,000 house because she's a first-time home buyer, which means to control a $300,000 asset, she only had to put $9,000 down, which is not bad at all. When I purchased my first property, it was a duplex. A duplex is considered a residential loan because it's not more than four units. So when I bought the duplex, me and my partner only had to put 3% down. Now, we did put 20% down, but theoretically, I could have controlled that $150,000 asset that was really worth $200,000, but I could have controlled that $150,000 asset for only putting down about $5,000. Then, now I control this $150,000 asset. I get somebody to come in, assess the property, property's worth $200,000 due to comps. I've used $5,000 to put down to make $50,000 in equity overnight. That's the power of real estate. And even if you're not a first-time home buyer, most of the time you just put 20% down and you can control an asset that the bank will owe, give you 80% for. So that's a huge, huge part of real estate because the banks know what it's worth. The next is tax write-offs. Tax write-offs are massive. So you can write off interest, you can write off property taxes, you can write off depreciation. So in the instance of this property right here, a lot of people can be like, dude, why would you put 3% down if you have more than enough money to just probably buy the house outright or to put at least 20% down? You're going to have interest, which our interest rate is like 2.4 right now, which is crazy. It's a really good rate. I can write that interest off. I can write off the property taxes. I am paying PMI, which is personal mortgage insurance. I can write the personal mortgage insurance off. I can depreciate the property. So when you buy a property like this, you can instantly write it off. So like I was saying before, with the property that we could have put $5,000 down, instantly made $50,000 equity overnight. Then I was writing off $10,000 a year on my taxes because I had $5,000 worth of interest I was paying a year. That's a write-off. $5,000 worth of property taxes every year, which is a write-off, and then I could have written off the depreciation on the property. So with putting $5,000 down, I made $50,000 in equity, and then on top of that, I could have written off $10,000 worth of my taxes right there, which I'm taxed at a 40% rate. So that pays for the house itself already. Now, we did put 20% down, like I said before, but that's the power of real estate. Now, think of it this way. Let's say you make $100,000 a year. If you could eventually own 10 of those properties and write off $10,000 worth of property taxes and interest each and every year, $10,000 per property, that's $100,000 in write-offs every single year you have, don't pay taxes. You don't pay taxes anymore because you're making $100,000 a year and you're writing off $100,000 a year, which is massive. So write-offs are insane. This is how rich people don't pay taxes, is because they buy properties and they write them off. The third thing is this does count as income to a bank, so you can go ahead and buy more. If you guys want, I'll do a video breaking down how you can essentially just go buy a bunch of houses for free after you purchase the first property. But you can essentially do a home equity line of credit and then go and purchase more properties. So in this instance, let's say that I make $100,000 a year and I have $50,000 worth of bills I have to pay every year. So my debt to income ratio is basically 2. I make $100,000 a year, I have $50,000 in debt, or essentially at the end of the year, I profit net $50,000. Let's say I go buy a property, and now the property, my debt to income ratio is going to switch a little more because now I have to pay about $15,000 worth of my mortgage every single year. The bill say like, $1,200 a month or something like that. What you can do is if your mortgage is $12,000 a month or $12,000 a year, let's just say $1,000 a month, $12,000 a year, and you could rent a duplex out. Let's say it's a duplex like my old place was. Our mortgage was like $1,075 a month. So basically we'll call it $1,100 a month. If we rented the downstairs for $1,000 and then rented the upstairs for like $900, that's $1,900 a month we're making. You can take those leases to the bank and you can say, hey, I have X amount of money or equity in the house, or even if you don't, and you don't have any equity in the house, you actually overpaid for it. What you could say is, hey, here's my lease. The mortgage is $1,000 a month. We're making $2,000 a month. You can go to the bank and they can be like, oh, that's great. We'll loan you another property because now your debt to income is actually better than before you bought the property, because not only are you netting by paying the mortgage with one of these units, you can actually make money, and you're making more money now from the second unit. So then they'll go out and they will offer you a loan to go buy a second property. You do the same thing with the second property. Third property, do the same thing with the third property. You can do all of this under your own name up until about 8 properties, which I'll do a whole video on that if you guys want. So the fact that tenant income counts as income, just like your job income does. There's appreciation 90% of the time, which we know that. There are the times like 2008, potentially now, when people are overpaying for homes and then they drop, but 90% of the time the market goes up. People will always rent. Even in a recession, people will always be renting properties. It is consistent income. If you have someone sign a lease and you know that you're going to make $300 a month profit, as long as they pay every month, you're going to be making consistent income. Not a ton of money to start. Let's say you only have $4 or $5 grand. If you're a first-time home buyer, like I said, you only have to put 3% down. You can also have a partner, but that's also a downside, like I said. Very easy to buy more properties like we talked about before. You do a home equity line of credit, you can rent them out, bring the lease to the bank and say, hey, I want to buy another property. I'll do a video on that in the future. And then depending on the time, extremely cheap rates, and you can write off that rate. So like I said before, even if you have a 5% or a 6% rate, which is very high right now, you can just write that interest off. So what are the real estate investing cons? Because after talking about that, I feel like most people be like, dude, I just need to go buy a property. Like, that's all the things he's talking about. Seems pretty easy. There are a lot of cons. Liquidity is one of those cons. If you put 50 grand into a house, you can't go pull that 50 grand out tomorrow unless it's a home equity line of credit, to pay bills or to pay for something that needs to be paid. It's not liquid. Selling a property does not happen overnight. The second thing is there's a crap ton of fees. The fees are insane. I mean, insane. So like, for instance, when we bought that property for 150 grand, even though I did make $50,000 overnight, I spent $10,000 just to close when I bought the property. Then I spent about $15,000 just to close when I sold the property. So that right there is already $25,000 just in fees to pay your closing costs, to pay the title, to pay the lawyers, to pay your agent, to pay a bunch of people to just pick their nose and do a bunch of like, literally you're just paying for everything. It's ridiculous. So fees are insane. The second thing is, in order to get a loan, you have to pass a ton of prerequisites. You can't just go get a loan if you don't have good credit. You can't get a loan if you don't have proof of income. You can't get a loan if your debt to income ratio is poor. So for instance, talking to you earlier about the partner I had, which I wasn't too happy about, I had to bring that person in, not for their money or not for their credit, but because I didn't have proof of income. I was trading stocks full time, making good money, but the bank didn't care. I needed his income because he was making like 70 grand a year with little to no debt. I needed his proof of income in order to get the loan. That's why I needed a partner. Like I said, no liquidity, must deal with people or pay a management company. You're going to want to be a people person if you're getting into this. You're going to have to screen tenants. You're going to have to evict people. You're going to have to go and see a bunch of properties. You're going to have to work with real estate agents. You're going to work with partners. You have to call plumbers. Like, you're going to have to do a bunch of stuff and work with people. So this is not passive by any means. So you can do that yourself, or you can hire a proper management company, which is very expensive for the most part. Another con is just things go wrong. Shit breaks. Like, it's just a part of it. And it tends to go wrong at the worst time. I put heater exploding. So in the winter of 2018, on the coldest day that there was, the coldest day, like I remember, I think it was below zero, our heater exploded at the duplex. No heat at all. We had to get the heater completely redone. The house was so old, and that heater cost us $6,000. Could have got it probably a lot cheaper, but because it was the coldest day in the middle of the night, next day we have to get heat in there for tenants. I was living there at the time in one of the units. I don't have much of an option to go pricing things out. Another massive con is legal fees and evictions. Evictions are terrible. They will last 90 to even more days than 90 days. It costs a lot of money to throw somebody out. So screening your tenants is extremely important. The next thing is there's a huge chance to get sued. There are people who will just sue you and fake, falling or getting hurt. But then there's also a chance that you really do get hurt, right? The mailman falls off your curb and breaks his arm. Little old lady's walking down the street, gets her foot stuck in like the curb right out front of your house. Like, there's a big chance to get sued. You're not going to get sued if you're trading stocks. You may need partners. We talked about that. Rates. If you have crap credit, you might have to pay a 10% rate. I mean, it just might not even be worth it to buy the property. Like I said, you may need partners. Upkeep, wear and tear, and then I put however it is a write-off. So if you're purchasing a property, use an LLC or create an S corp. Even if it's just you, make an LLC. So if I go out and buy a property, I'm not buying it under my name, Peter DiCarlo. I'm buying it under an LLC, maybe DiCarlo Capital. The reason for this is, number one, whatever money I spend on the property, I can write off. And also, number two, if the little old lady falls and breaks her hip, she can only sue the business. She can't sue me and take my personal house and my belongings. You're separating yourselves. And so let's say I buy a property and the heater explodes. If I pay 6 grand to fix the heater, I can write $3,000 off, or I can write that whole $6,000 off at the end of the year because it's a business expense. The next issue is crappy tenants. Tenants just break stuff. I don't even know how it happens. You're gonna basically have to repaint the whole house, put new flooring in. Like, there's gonna be so much stuff. I don't know how tenants are so bad. And then also a ton of responsibility. There is a lot of responsibility. There's not a lot of responsibility when it comes to the stock market. I hope this video helped, guys. This is the longest video I've ever made. We're nearly at a half hour, but there are a lot of different topics that I could talk about, within talking about all this stuff, which I'm probably going to do videos on it, like how to roll over different properties, how to buy more properties, how to buy properties for no money. There are some ways to do it. Some of them are sleazy, but, a lot of people teach them. And I hope this video helped. Overall, I think investing in both of these are extremely important. The one thing that I will say personally, I would only invest in real estate if you have a lot of money and a lot of time. Because when I first bought my first property, I wasn't making the money I'm making now, right? Like I didn't have a company that was making more than $250,000 a year. I was trading, making 60, 70 grand a year. And when I bought my first property, I put like $20,000 down. There was a point for like 7 months that if crap hit the fan, I had no money to go and fix it. I had no money to buy a partner out. I had no money to do anything. And so you're going to want to have extra money. If you have 50 grand, don't go putting off 50 grand into the market or going into a piece of real estate and not having any money on the side. You're going to want more money so that you can do things correctly. You don't want to half-ass, doing anything in real estate. You really don't. So for me, I think that real estate is extremely important. I think real estate should be a part of everyone's portfolio, whether you own it with a partner, whether you own it yourself, whether you pay a property management company. I feel like it's extremely important, but I feel that for 90% of people who have less than like 50 grand in their bank account, stock market is probably the way to go, and then move into real estate later on. Guys, I hope this video helps. Hit the like button, subscribe. If you watch till the end, you are an MVP. Like you're a savage. You take this seriously, and I really applaud you guys for it because so many people fail when it comes to real estate investing, stock market investing, business building, anything. People just fail all the time, and it's not because it's hard. It's just because you have to put the work in. And a lot of people don't. Right? A lot of people just don't. So thank you guys, and I'll see you next time. Peace.